Everyone wants to grow their wealth, but not all investments are created equal. In fact, some investments can quietly erode your wealth over time, leaving you worse off than when you started. Welcome to Forever Finance, where we want to live our lives our own way. Whether you're just starting to build your portfolio or you're a seasoned investor, avoiding these wealth-destroying traps is crucial. The first investment that could be destroying your wealth is overpriced managed funds. Managed funds are a popular choice among Australian investors who want to leave the stock picking to professionals. But what many don't realize is that the fees attached to these funds can significantly drag down your long-term returns. Managed funds come with management fees, often hidden within the product disclosure statement. While 1 to 2% per year might not seem like much, those fees add up over time. Over a few decades, that small percentage can cost you hundreds of thousands of dollars. Let's take a closer look. If you invest $100,000 in a managed fund with a 2% annual fee, you could end up paying over $100,000 in fees after 30 years. By contrast, investing in an index fund with an ultra-low 0.1% fee would cost you only a fraction of that, around $10,000 over the same period. The bottom line is that paying high fees often doesn't translate into higher returns. Research shows that most high-fee managed funds fail to outperform cheaper alternatives like index funds. The difference in fees could mean the difference between a comfortable retirement and financial stress. Next up, SMSFs with small balances. Self-managed superannuation funds have become increasingly popular, giving investors more control over their retirement savings. While SMSFs can be a powerful tool, they're not for everyone. If you're running an SMSF with a small balance, you could actually be losing more money than you're making. SMSFs come with costs. There are accounting fees, audit fees, and potentially even investment management fees. These expenses are manageable if you have a large balance, but for accounts under $500,000, the fees can quickly outweigh the benefits. For example, an SMSF with a balance of $200,000 might incur annual costs of $5,000 or more. If your returns are modest, say 5%, you've already lost a quarter of your gains to fees. That's before you even factor in market volatility and investment risks. On the other hand, industry super funds offer lower fees, strong performance, and are professionally managed, which makes them a better option for most Australians with smaller super balances. Instead of risking your wealth on the complexity and costs of an SMSF, you may be better off sticking with a low-cost, high-performing super fund. Number 3. Off-the-plan apartments. Off-the-plan apartments have been marketed as a smart investment in Australia's booming property market. The appeal is obvious. You lock in today's price, and by the time the apartment is built, it could be worth more. But the reality often falls short, and off-the-plan investments can destroy wealth in unexpected ways. First, the property market can fluctuate significantly. While Australian real estate has generally increased over time, not all areas or developments experience the same growth. Off-the-plan buyers are often left holding the bag when property prices fall between the purchase and settlement dates. Second, new apartments often come with inflated prices as developers build in their profits and marketing costs. This means you might be overpaying compared to similar existing properties in the same area. To make matters worse, many off-the-plan apartments depreciate in value as soon as they're completed, especially if there's an oversupply in the area. Another risk is the difficulty of reselling or renting out these apartments. In cities like Melbourne and Sydney, thousands of new apartments can flood the market at once, driving prices down and making it harder to find tenants. As a result, investors can face long vacancies or lower than expected rental yields, turning what seemed like a good investment into a financial headache. The fourth investment that could be destroying your wealth is speculative mining stocks. Australia has a booming mining industry, and it's easy to see why many investors are drawn to it. The promise of striking it rich by investing in small mining or exploration companies can be tempting, especially when you hear stories of major discoveries leading to massive share price increases. But the reality is often far riskier than it seems. Mining stocks, particularly those focused on exploration, can be incredibly volatile. These companies often have no revenue and depend on future discoveries to generate profits. If the exploration doesn't pan out or commodity prices drop, the stock can plummet, leaving investors with significant losses. Another factor to consider is the unpredictable nature of commodity prices. Even if a mining company strikes a valuable deposit, the profitability of that mine depends on global demand for the resource. For example, iron ore or gold prices can swing wildly based on international trade policies, economic conditions in China, or new supply discoveries elsewhere. These fluctuations can make even seemingly stable mining companies high risk. Building wealth requires not just choosing the right investments, but avoiding the wrong ones. By staying informed, focusing on cost-effective investment options, and doing your research, you can make smarter financial decisions. It is not just your investment choices that can cost you your wealth. Choices that you make each day can also cost you. Check out this video to make sure you avoid eroding your wealth further.